Global markets started the week on a soft note as rising yields around the world and renewed oil volatility weighed on sentiment on Monday's trading session. The US dollar initially weakened on softer US jobs, inflation, and retail sales data of past weeks, which have helped temper expectations for Federal Reserve tightening, but the dollar index rebounded today as crude prices pushed above the $85 per barrel level for the US crude. Yet if you look beyond the short-term oil swings, a cautious European Central Bank stance, softer Federal Reserve rate expectations, and longer-term concerns around the US debt and the dollar debasement trade could continue to support the euro, and that despite significant geopolitical and energy risks in the short run. So welcome to Swissquote's Daily Market Talk. It's August 18th and I'm İpek Özkardeşkaya. Today I will dive into the euro's short and longer term prospects, but before I do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the week started on a weak note for US and European equities as rising global yields reversed early Asian optimism, and today Nikkei is down by 1.53% in Japan at the time I'm talking here, as the Korean Kospi index failed to extend its gains above its 100-day moving average. In the FX markets, the muted reaction in oil prices, the weekend Middle East tensions helped pulling the US dollar lower at the very start of the week across the board. Having failed to break the 100 resistance last week, the US dollar index took a dive to 99.30 level. That was the lowest level since the beginning of June for the US dollar index. Yet, the US dollar is rising again this morning as crude oil broke its early Monday silence later in the session, and US crude jumped past the $85 per barrel level on renewed Middle East worries. But zooming out, since the US jobs data printed a negative number on the first Friday of the month of August, and the data was backed by softer than expected US inflation and softer than expected retail sales data on the following week, meaning last week, the US dollar has become more sensitive to the weakening US data that tames hawkish Federal Reserve expectations today for the rest of the year. Now, this situation flips, of course, when the rise in oil prices accelerate, and this is what we see today. But the broader post-FOMC trend is that the soft US data and the softening Fed expectations are giving support to the major peers against a weaker US dollar. Many now expect that the Fed will skip a rate hike in September, and activity on Fed funds futures gives a bit more than one chance out of three for a 25 basis point hike next month from the Fed. Now, in the short run, today, the dollar yen is pushing higher again toward the critical 160 level on the back of a broadly stronger US dollar. But looking at yesterday's trading session, Monday's data actually showed that the Japanese GDP growth unexpectedly slowed as capex declined in the second quarter of this year, somehow reversing the yen appreciation yesterday, and the dollar yen remains today at very uncomfortable levels for the Japanese officials, and reversing the yen's depreciation sustainably has become a policy priority for the Bank of Japan and even the Japanese government. According to a former finance minister, the Bank of Japan should raise interest rates at every meeting until it reaches the 2% mark to narrow the rate differential with other major currencies to reverse the yen's weakness in a sustainable manner. But if the Bank of Japan is ready to do so, to hike interest rates into softening growth and investment numbers, building exposure to the yen is still a risky trade. It comes with the risk that Sanae Takaichi's government could make a U-turn and re-pressure the Bank of Japan for keeping interest rates as low as possible to prevent a full-blown economic meltdown in Japan. So it is still a very fine balance that the Bank of Japan and the Japanese government should walk. That makes me think that it's perhaps better to wait before jumping into a long yen trade right now. For the euro, however, the outlook is improving. The euro dollar yesterday has pulled out the year-to-date bearish trending channel top and tested the major 38.2% Fibonacci retracement on January to June retreat to the upside. Clearing this resistance could push the euro dollar into what could become a more sustainable medium-term bullish consolidation zone with a support near the 115-115.10 range, an area that has acted as a solid support since the beginning of August. Again, oil prices will remain critical for the US dollar short-term direction, hence the euro dollar short-term direction, yet there are broader factors out there that are supporting the positive euro outlook. One, the softening Federal Reserve expectations versus a more cautious European Central Bank stance, which is ready to tighten its monetary policy further to keep inflation in the euro area under control, but also the longer-term USD basement trade that weighs on US dollar and the longer-term US treasuries today. For the former, the central bank expectations, the Fed ECB divergence plays in favor of a stronger euro in the medium run. In the US, for example, the FOMC minutes that are due on Wednesday will probably give little clarity on how the Federal Reserve will react to inflation under the new Fed chair Kevin Warsh. The recent confusion regarding the Fed's new reaction function to inflation is among reasons why the US dollar lost ground in the past weeks. While in Europe, the European Central Bank Chief Christine Lagarde's comments due later this week could reconfirm the bank's cautious stance and keep the hawks alert. Note that strong second quarter earnings season for the big European companies, and that despite the Middle East-led energy crisis and climate headwinds. And the Middle East war softer than expected impact on European activity levels, whether it was due to the World Cup and or hot summer months that forced people to go out and spend their money, also give the European Central Bank a greater margin today to stay firm against the rising inflation threat in the coming months. And for the latter, the debasement trade, the longer-term outlook for the US dollar and US treasuries remains bearish due to the fast-growing US debt and confusion around the Fed policy. For the long end of the US yield curve, whether rising long-term yields could eventually attract enough demand to put a floor under the treasury prices in the US and somehow support the US dollar remains to be seen. Here, the so-called crowding out of the bond markets by an avalanche of big technology bond issuance this year to finance the massive AI build-out is also thought to be competing with the US treasuries these days, hence contributing to the gradual steepening of the US yield curve. The latter could eventually support the US dollar at some point in time, but on the shorter end, if the economic data in the US continues to soften the Federal Reserve's rate hike bets, then the shorter end of the US yield curve should remain contained and the latter would further weigh on the US dollar appetite. So consequently, if we summarize all of this, in the short run, if the Middle East tension trade eases again, I expect to see gains in the euro dollar extend above the 200-day moving average that presently stands near the 116.30 mark. In the medium run, the pair will remain in the bullish trend building since the beginning of 2025 above the 113.50 level, which is the major 38.2% Fibonacci retracement on 2025 to date appreciation in the euro dollar. But on the upside, we could see resistance into the 118-120 range if the US-European rate differential widens sufficiently to cover for inflation and attract capital into the US-denominated assets, with big technology bonds obviously vacuuming strong demand from international investors. Yet the big technology companies don't only issue bonds in US dollars. The dollar today accounts for roughly 2/3 of big technology bond issuance, but foreign currency denominated bonds have jumped to more than 1/3 this year, and issuing abroad reduces the amount of supply the US dollar credit market has to absorb and could relieve some upward pressure on the US corporate yields, hence somehow maybe limiting the US dollar's capacity to rebound in the longer run, also lifting the euro's prospects as a funding currency internationally. Note, however, that in the short run, a sharp rise in European yields due to geopolitical tensions and energy crisis would have the opposite effect of destroying growth outlook for Europe, and that could reverse euro appetite despite the rising yields, while the US dollar, US treasuries complex is more immune to energy crisis, as the United States is a net exporter of energy, whereas the European Union is a net importer. So that's perhaps the biggest risk to euro's positive outlook in the shorter run, but doesn't change the picture for the longer run. The longer run euro outlook is positive today. So this is all for this Tuesday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.